with for IAS 2 inventories. IAS 2 inventories. Okay. So as you all know, we've heard of inventories before and we know what the definition is. So I think we will not waste much time there. So we are saying that inventories are assets. Because when you look at the statement of financial position, you see inventories, current assets. Under current assets, you will see what inventories. So we are saying that inventories are assets held for sale in the ordinary course of business, or they are assets that are used in what the process of production for sale, or the assets that is in the form of raw materials or supplies to be used in the what production process. In the production process. So we have this measurement rule, recognition, and all that. So as I said, those things I think corporate reporting is okay for us now. You know what measurement is, the recognition, and also disclosure. All right. So let's define the cost. All right. So this one is similar to that of PPE, the component of cost. But before that, I think that the measurement rule, IS2, requires that inventory must be measured, okay, at the lower of costs or net realizable value. So in every question that will be given, you will be asked to calculate the cost and net realizable value, or you'll be given one of them, either cost or net realizable value. Then you calculate the other, all right? Then you use the lower, all right? So initially, you measure it at cost, all right, okay? Then subsequently, you measure it at the lower of cost and also net realizable value. So definition of cost, the cost includes all the cost of purchase, cost of conversion, okay, conversion, that is when um, you are involved in what production, okay, so right from the raw materials to the finished goods, because you cannot use, sometimes you cannot sell the raw materials, you have to convert the raw materials to finished goods before you sell to your final consumers. So the cost involved during that production process will also be added. And this time around, because it's an asset, you will be adding the production overhead. Thank you. So as I was saying, with this one, with the cost, you add the production overheads, uh, and also we've heard of this in management accounting and all that. Another cost incurred in bringing the inventories to their present location and condition. Okay, so we've done PPE, so we don't waste much time there. So the component of cost, as I said, is similar to that of what um, PPE. So first of all, we have the purchase price. Okay, we have the purchase price, and also um, the import duties. Okay, so we are talking about the non-refundable purchase taxes and all that. Handling costs, transports, then you subtract your discounts. Okay, so trade discounts, not the early settlement one. We are talking about trade discounts and any rebate, and also costs which are specifically attributable to units of production. So this one we have direct labor, direct expenses, subcontracted work, convention costs. So I've already talked about this one. And let's talk about the directly attributable costs. So we have the production overheads. So this one, as I said, we've heard of it under MA. Then factory overheads, the same thing, carriage inwards and all that. Normal loss. Okay. And this cost when you have maybe list of items, okay, or list of costs that you should determine the cost of inventories. The following costs should be what excluded from it. So we are saying abnormal waste, storage cost of the storage cost is not storage cost of all the inventories, it's storage cost of what finished goods. Storage cost of what finished goods. But when you have the storage cost for raw materials and also work in progress, their storage costs are included in what determine the cost of inventory. Again, when you are determining the cost of inventory, the storage cost of raw materials and also work in progress are included in determining the cost of inventory. But if the storage cost was incurred as a result of finished goods, then that one will be excluded because that one will be expensed. Administrative overheads, which do not contribute to bringing the inventories to their usable state and location. Selling costs, foreign exchange differences, that's the rates and all that. That one there is not part of it. Okay, so that one will be expense. Interest costs when inventories are purchased with deferred payment conditions. Okay, so maybe you deferred your payment, maybe they added some interest, or it's more like paying a fine, okay, or maybe a penalty. So that one will be excluded. All right. So this is how you determine the cost of your inventory. As I said, we've already done PP, so you will not waste much time there. Then the net realizable value. Okay, so I think this term to be needed in the subsequent standards. So the NRV is the estimated selling price in the ordinary cost of business, less the estimated cost of completion and the estimated cost necessary to make the sale. So it's just the selling price minus the cost to sell and also cost of what completion. So as I said, we have some raw materials that you have to convert to finished goods and all that. So the cost of completion and also cost to sell, you subtract these two costs from the estimated selling price of your inventory, and that will give you the net realizable value. Okay, net realizable value. So we have types of inventories. We can talk about goods purchased and held for resale. We have finished goods produced, work in progress being produced, materials and supplies awaiting use in the production process. So this one can be the raw materials. Okay. So the other day I was saying that depending on the question, okay, when we take building like this, we all know building is what non-current assets. But depending on the industry, okay, or depending on the company in that particular question. For instance, real estate, okay. Real estate, in the ordinary course of business is what? In these buildings and all that, okay, so buildings will form part of their inventory. So please let's take note. It's not always that building will be used under non-current asset. Sometimes building will fall under inventory. Okay, so we did investment property and we saw it. Okay, so the measurement of inventory, I've already stated this one, that inventories are measured at the lower of cost and also their net realizable value. lower of cost and net realizable value. This is a short standard. This is what you should know. And we are saying that the standard allows just three methods. Okay, but mostly the actual unit cost is out. So let's pick the FIFO and also the weighted average cost. But the actual unit cost is the cost of the unit. Okay, that is the cost of that particular inventory. But with the first in, first out, I think we've heard of it. And most of the times, you are not going to calculate the figures because they've already determined using the FIFO and also the weighted average cost. Then you have to do the necessary adjustment or the necessary calculations. Okay, so I think this one was cost accounting or something. Yeah, so we learned of FIFO and also LIFO, weighted average, and all that, simple average. But I are saying that the use of LIFO is prohibited in this standard. This standard does not allow the use of what? LIFO, last in, first out. That's the full name, last in, first out. All right, so this one is just short standard. When you get the note, you can read the note and to get the full uh, explanation. But that's the summary I've given you, and that's all what you need in solving questions under inventories. So please let's pick this particular illustration. Okay. Yeah, I think four. So let's solve them and you move on to IS-20 government grants. So please, someone should read the first illustration from illustration one.
Illustration 1. The following is inventory information by ABC Limited as December 2013. So we have item A, B, C, D, and E. We have the cost, estimated selling price, cost to complete, and number of units. Based on the above information, determine the determine the inventory values as at 31st December 2013.
Okay. So we already know the measurement rule. Okay. So we have to determine the cost of these inventories, right? So I think we will start this. All right. So let me. So we have your item here. So you just have to know that you measure the inventory at the lower of cost and also net realizable value. And I think if you know how to calculate these two things, you don't have problem under this standard. Okay, because no one is going to ask you about the disclosure and all that in corporate reporting. So the item, we have costs, we have the estimated selling price. Okay, so let me do it like this. Well, let me bring the NRV here. Net realizable value. Let me bring the value that you are going to choose. The number of units will come. Okay, then the amount. Okay, so okay, so we have A, B, A, and E. So the cost we have 2 cedis, 4 cedis, 6 cedis, 5 cedis, 1 cedi. So How do you determine your NRV? I explained it. So if you remember, how do you determine it? Hello, question to the class, please.
The amount we receive from the sales less cost to sell.
Okay, so
Proceeds.
the estimated selling price less cost to complete. Okay, so that's what you are going to use. Okay. So this one will give you 2. Okay, so give me the remaining ones because I think now I've given you the clue to determine the NRV.
So we have 3.2,
3.2.
9, 4, and 1.2 minus 0.95.
Thank you. So now let's compare. We are choosing the lowest amount. So for A, cost is 2. The NRV is 2. So we are going to choose 2. They are the same. Okay. The B2, we are going to choose the lowest one. That is 3.2. C, you will choose 6. You choose 4 here. You choose 0.95. So let's multiply the value here. This column, let's multiply by the respective number of units. Okay, so please kindly do the calculations for me. At the end of the day, we
Perfect.
have to add everything.
So we have 1,000, 3,200, 4,500, 3,000, and 2,375.
Okay, so please let's find the total. And the total amount is what we are going to recognize. Okay. So this one is just a simple question.
11,375.
11.
Yeah. Please, it's wrong.
14075. Oh,
Mm-hmm.
Getting. Okay. So that will be the cost. Okay. So this one is quite straightforward. Let's move on to illustration 2. Please read it for us.
Okay, illustration 2. Z Limited. Z Limited is a manufacturing company. The cost per unit of an item of inventory is shown on its card as follows: materials, production labor costs, production overhead, general administration costs, then marketing costs required. According to IAS 2, Inventories. What is the value of one completed item of inventory in Z Limited statement of financial position?
Okay, thank you. So this is what we are going to do. Um, so so please, based on the component that we just discussed, you can tell me the cost of that particular inventory. So we are going to add materials 30. What again? Production labor costs. So that is the direct labor 33. Production overheads, yes, but you will not add general overheads. So production overheads, that one is 12. Are we going to add general administration costs?
No.
Okay, so this one is out. Uh-huh. The marketing costs, are you going to add it?
No.
Okay, so the cost will be
75.
okay. So let's move on to illustration 3.
The following figures relate to inventory held by Sankofa Limited at the year end. We have A, B, and C. Then there's cost, selling price, modification cost to enable sale, unit held, required. Calculate the value of inventory held.
Okay. All right, so this one I'll bring the costs 29, 12. Selling price, we have 30, 30, 12, 22. Then the modification cost to enable sale. Okay, so this one is like uh, determine the NRV. This one is the estimated costs necessary to make the sale. Okay, so um, modification costs. Let me just write cost to sell. So that one we are going to deduct from selling price to determine our NRV. So that one is 2. This one is 8. So please give me the NRV, net realizable value. This one is still 30, 10, and what? 22 minus 8. Please.
14.
14. So now we are going to compare this one, the NRV, and also costs. Okay. So please let's choose the lowest. So the value per unit. Yes. So value per unit. So please let's compare the two. We are picking the lowest one. For A, we are picking 20. For B, we are comparing 9 and 10. You choose what? 9.
9.
C,
Then
we are comparing
12 and 14.
and so which one are you going to choose?
12.
Come on, okay. Okay, so I think 12 one we are going to choose. Then unit 200, 150, and also 300. So please give me the total. At the end of the day, we have to add all of it to get the total cost.
Okay, so we have 4,000, 1,350, and 3,600.
So add all of them for me to get the total cost.
8,950.
So please, I hope you are okay with this one. So IS2 is not difficult. Okay. All right. So please, this some past questions that we have. Okay. So please, let's solve the first one, so that we end this particular standard. So please read for me the first one.
Okay, so Isinam Limited has the following products in inventory at the end of 2016. We have Ahomka completed, Adonko part complete, and we have their unit and cost per unit. Each product normally sells at 34 cedis per unit. Due to the difficult trading conditions, Esinam Limited intends to offer a discount of 15% per unit and expects to incur 4 cedis per unit in selling cost. 10 cedis per unit is expected to be incurred to complete each unit of Adonko required in accordance with IAS IS2 inventories. At what amount should inventory be stated in the financial statement of Islam Limited as at 31st December 2016?
Okay. So let's do it together before we move on to the next standard. Sorry. So we have Ahunka. So Ahunka is what type of inventory? Looking at this.
The finished product.
And Adonko.
Work in progress.
Thank you.
Please, I didn't hear what she said.
So the first one you see completed. So finished goods. Adonko is part completed, work in progress. I hope you understand.
But I didn't hear you for the first one.
Okay, so you see we have the inventories. We have three types, right? Raw materials, finished goods, and also work in progress. So you see they've written Ahunka completed, Adonko part completed. So Ahunka is the finished ones, okay, the one you can sell to your final consumers. Adonko, this one is part complete. So this one work in progress. Okay. So this one you've not finished the production yet. All right. So please, I hope you understand now.
Yes,
Hello.
please. Yes, please.
Okay. So let's move on. So costs. The costs we have 22 per unit for Ahunka, 26 for Adonko. Now let's determine the NRV, the net realizable value. Okay. So first of all, we start with the selling price. So we are saying that each product normally sells at what? 34 cedis per unit. He said that S now intends to offer a discount due to what? Difficult trading conditions. So please, what type of discounts is this? Hello. 3-column cash book. What type of discount is this one? Okay, let's move on. So the discount is 15% of the selling price, right? 34. So please, what's the answer? Hello.
Pa,
Yes.
please, we don't know what kind of discount it is. Me, I don't know. So if you can say it, that'll be
So
good.
we have the discount allowed and discount received. So this is a discount allowed.
All right.
Okay.
So this
Sounds
one
good.
will be an expenditure for the
Yeah.
organization.
Okay. All right. Thank you very much. So 15%
So
of 34 is 5.1.
5.1. So they will deduct it. So they are giving them discounts due to difficult trading conditions. Okay. Now let's look at this. They are saying that um, they expect to incur 4 cedis per unit in selling costs. Okay. So that is uh, um, the cost to sell. Okay. Cost to sell. So we can just write selling costs. So selling cost is what? 4 cedis each. So that one we are going to deduct from the selling price because that's part of the rule. Then the 10 cedis, let's look at the 10 cedis. 10 cedis per unit is expected to be incurred to complete each unit of Adonko, the partly completed this thing, inventory, or maybe product, that's Adonko. You have to incur 10 cedis per unit before they convert it to what finished goods. So that one too is cost to complete. The Amka is a completed product, so that one you don't need it. 10 cedis is for just Adonko. So please, what is the net realizable value? So this one is NRV per unit. So please, what do you have?
We have 24.9 for Ahunka and 14.9 for Adunko.
Okay, so let's do this. Value per unit. You know value per unit, lower of cost and also what net realizable value. So for Adon Ahunka, we are choosing what the lowest one, that is 22.
Sure.
Okay. Then Adonko 26, and this one we are choosing the lowest one, 14.9.
Mm.
Number of units, we have 5,400 for this one and also 2,800 for this one. So I'm just going to multiply. Okay.
The first one, for Honka, we have a total of 118800, and for Adonko, we have 41,720.
So please let's add it. So please, all of us should help. That's what you want. Concern very content.
We have a total of 16,0520.
Okay, so what is the total cost of what? The total the amount that should be stated in what the financial statement of SNAM. So when you go to the um balance sheet, that is statement of financial position and the current assets. Okay, so you see, so there's a simplified one. There's a simplified one. See, we all got the same answer, so no problem. So please, I hope we are okay here.
Yes, please.
Okay, so we are done with this particular standard. As I said, we don't need much here. All what we need is what we've done. How to measure the inventory, lower of cost and net realizable value. Okay, net realizable value. We've determined what the net realizable value is. Okay, so please we move on to IAS 20. IAS 20. All right. A moment before I change to the